Hello, class. Hope you're doing great. Welcome to FinQuiz. Let's explore a part of alternative investments that's all about stuff you can actually walk on, live in, or drive across. We're talking real estate and infrastructure. When you think of investing, you probably imagine the usual suspects: stocks, bonds, and maybe a savings account gathering dust. But when we talk about alternative investments, we step out of that comfort zone into something a little more dynamic, a little more specialized, and yes, sometimes a little more complicated. These aren't just alternatives in the sense of being different. They're essential tools for building a robust, diversified portfolio. Think about it. Traditional investments are like plain vanilla ice cream. Sure, they're dependable, but what if you're craving something more exciting like Rocky Road or cookie dough? That's where alternatives come in. For today's discussion, we're zooming in on two key players in this space: real estate and infrastructure. Together, they offer unique opportunities to diversify risk, stabilize returns, and even hedge against inflation. All right, team, let's explore one of the most tangible, relatable parts of alternative investments: real estate. And let's be honest, this is one of those topics where you don't need a finance background to care. I mean, who doesn't dream of owning property someday, right? But here's the twist: real estate isn't just about buying a house and calling it a day. It's a full-blown investment strategy that institutions, billion-dollar funds, and everyday investors use to build serious wealth. Oh, and the battle-ready summary you're seeing on screen? That's your go-to visual map to make all this click fast during revision. If you want the full set, summary sheets for all learning modules, go check the link in the description. It's helped thousands of candidates walk into that exam room with confidence and walk out with results. Real estate is what most people are familiar with. You live in it, rent it, maybe flip it on Zillow. And infrastructure, think roads, bridges, airports, even communication towers. The backbone of modern economies, whole different ball game. Office buildings, malls, warehouses, rental apartments. These properties are higher in value per unit and usually generate rental income from businesses, not just tenants. These assets are big, bulky, expensive. And unlike stocks, they don't disappear overnight because of a tweet. Now, why do investors care about this stuff? Well, because real estate and infrastructure don't always dance to the same tune as stocks and bonds. When equity markets are throwing tantrums, these real assets often keep plugging along, generating steady income. They offer diversification, inflation protection, and a totally different risk-return profile. But they're not easy. They demand specialized knowledge. It's not like clicking buy on your brokerage app. Real estate investment typically covers two broad types: residential and commercial. So what exactly do we mean by that? Residential is the stuff we're all familiar with: single-family homes, townhouses, condos, those apartment buildings that take up half your Instagram feed. And here's a stat to make it stick. Residential real estate accounts for over 75% of global real estate value. That's huge. Why? Because people always need a place to live, no matter what's happening in the economy. Now, commercial real estate is where things get a bit more Wall Street. We're talking office towers, shopping malls, industrial warehouses, even luxury hotels. Each property might be worth millions. Ever seen a WeWork in a high-rise building or a Starbucks in a retail plaza? That's commercial real estate at play. The key difference: residential is mostly for living. Commercial is designed to generate rental income. It's business driven. Now, let's break this down into a relatable scenario. Imagine owning a single family home in a quiet neighborhood. You decide to rent it out, earning consistent income from your tenants while the home's value slowly appreciates over time. Simple, right? Now, compare that to owning a commercial retail space in a busy shopping district. Your tenants are businesses, maybe a coffee shop, a boutique, or a small gym, all paying rent that contributes to your income. But commercial properties are also more sensitive to market conditions. A downturn in the economy could lead to businesses closing, affecting your rental income. What's clear is that residential real estate tends to offer stability and accessibility for most individual investors, while commercial real estate often demands more capital, expertise, and tolerance for risk. Now, why is this distinction so important for you as future CFA charter holders? Because understanding these nuances helps you guide your clients or yourself toward the right investment based on their goals, risk tolerance, and financial situation. Residential real estate is often the entry point for individual investors, while commercial real estate offers opportunities for higher returns, but with greater complexity. Now, let's look at how you can actually invest in real estate, because most of us don't have millions lying around to buy a skyscraper in Manhattan. Now, when it comes to investing in real estate, you've got two main pathways. You can either go direct, meaning you buy the property yourself, or go indirect through something like a REIT, which we'll hit in a moment. Just like with stocks or bonds, real estate investment comes in two flavors, equity and debt. Let's zoom in and make sense of it piece by piece. Equity real estate investment is when you own the property, plain and simple. You're the landlord, you collect the rent, and you ride the wave of property value appreciation. Think of someone who buys a duplex in Austin, Texas, renovates it, and rents it out to tech workers. Debt real estate investment is different. Here, you're basically lending money, usually through mortgages. These loans are bundled up and sold to investors as mortgage-backed securities, or MBS. It's the same stuff that was at the heart of the 2008 crisis. Yeah, that one. But don't let that scare you. When done properly, debt investment in real estate can offer a steady income stream with less hands-on effort. Let's pause and think how this might show up on the CFA exam. They could ask you to identify the difference in return sources between equity and debt real estate. Remember, equity gets rent and appreciation. Debt gets interest income. Simple, but easy to miss if you're rushing. From an investor's lens, real estate gives you two flavors: cash flow, that's rental income, and appreciation, property value going up over time. But don't be fooled, real estate is no passive walk in the park. Now let's talk real estate features. This asset class is a bit high maintenance. First off, it's expensive. You need a chunky upfront payment, usually in the form of a down payment or full cash if you're a REIT. High upfront costs make it hard to enter. Then there's the uniqueness of each property. No two buildings are exactly alike, and that makes valuation more of an art than a science. It's not like a stock where price discovery is instant. Another kicker? It's not easy to diversify. Unlike mutual funds where you can buy into 500 stocks in one click, real estate requires deep pockets if you want exposure to different property types and locations, and the market isn't very transparent. In stocks, you get minute-by-minute quotes. In real estate, you might have to wait weeks just to get comps, or worse, depend on outdated appraisals. Transaction costs? Oh, they'll eat you alive. Agent fees, legal work, inspections, it adds up. And because real estate is location dependent, you could own a property in a booming city and be set, or one in a declining town and struggle to sell it for years. Local market conditions matter a lot. Also, it's not plug and play like stocks. Real estate requires specialized skills, negotiation, property management, understanding tenant law. This isn't something you just learn overnight. All right, now let's talk about the structures of real estate investments. Just like you have common versus preferred stock, you have public versus private real estate and debt versus equity. If you're going the private equity route, You could be a solo landlord, join a joint venture, or enter a partnership. Public equity, that's where REITs and ETFs come in. You're basically buying shares in companies that manage properties. For debt investments, privately, you can do mortgage loans, mezzanine loans, or even construction lending. Publicly, you've got your mortgage-backed securities, MBS, commercial MBS, and mortgage ETFs. Okay, quick example. Say Blackstone creates a private real estate fund targeting luxury apartment complexes in Miami. That's private equity real estate. Now compare that to VNQ, a popular public REIT ETF that tracks a basket of US REITs. You're in public equity real estate now. Speaking of REITs, let's spend a moment here because this is definitely testable on the CFA exam. A REIT is like a mutual fund for properties. You get exposure to real estate without needing to deal with tenants, plumbing issues, or maintenance calls at 2 a.m. There are three types: equity REITs, they own property; mortgage REITs, they invest in loans; and hybrid REITs, they do both. Equity REITs are the most common. Why do people love REITs? Because they're tax advantaged. They don't pay corporate income tax if they distribute 90% of their taxable income as dividends. That means higher payouts for you. They're also liquid. You can buy, sell on the stock market, transparent, regulated like public companies, and focused on income. But they come with a catch. They're more volatile, especially during downturns, because they move with the broader stock market. That's one of the downsides of being listed. Let's say you're analyzing a question on REITs in the CFA exam. They might give you a scenario involving tax treatment, income stability, or market correlation. Make sure you recognize that REITs avoid double taxation, but carry higher stock market sensitivity. All right, now let's talk about how investors actually get into real estate. Because it's one thing to know about residential versus commercial or debt versus equity, but how you access real estate matters just as much. You got two broad doors here: direct investment and indirect investment. And trust me, they come with two very different lifestyles. Let's start with direct investment. This is the roll up your sleeves and do it yourself version. You're buying the property, managing the tenants, handling the repairs, setting the rent. Full control. If you want to decide whether the floors get hardwood or carpet, you call the shots. And guess what? You also get to keep the rental income, enjoy tax benefits like depreciation deductions, and possibly see some nice appreciation over time. That sounds dreamy, right? Well, here's the fine print. Direct investing isn't for the faint of heart. You've got to bring serious capital to the table, especially if you're buying anything in a major city. Then there's the management burden. Think late night phone calls because the heating broke, or chasing down rent from a tenant who conveniently forgot the first of the month. And let's not forget about liquidity. Selling a building takes time, paperwork, and patience. It's not like unloading a few shares of Apple stock. And if you're a small investor, there's something called concentration risk. You might have all your eggs in one basket, a single building in one zip code, and if that market tanks, well, you're riding it down with the ship. That's why a lot of investors don't go it alone. They hire help. Which brings us to management methods. There are three main ways to handle a direct real estate investment. You can go self-managed, do everything yourself like a solo landlord, or you can use advisors, which is pretty common in the commercial space. These folks help you find, finance, and operate the property. And finally, institutional investors like pension funds or insurance companies often use separate accounts. That means they still own the properties, but hand over the daily decision-making to professional asset managers. Think of it as hiring a CEO for your building portfolio. Now, If all that sounds like way too much drama and paperwork, there's a softer route: indirect investment. Here, you don't buy the property, you buy into a vehicle that owns the property. That might be a limited partnership, a mutual fund, a real estate ETF, or even a REIT. This way, you get exposure to real estate returns, rents, appreciation, everything, but without the hassle of managing a property. You also get diversification. One REIT might give you a piece of 100 shopping centers. That's way safer than tying all your cash into one studio apartment in Chicago. And since these indirect vehicles are usually traded on public markets, you get liquidity. You can buy or sell with a few clicks. Now, from a CFA exam perspective, here's what they love to test. They'll give you an investor scenario. Maybe someone wants high income but low effort. Boom, indirect investment. Or maybe someone wants control and doesn't mind the work. That's direct. Watch for keywords like control, liquidity, capital needs, and management burden. They're signaling which path is better suited. And remember this little FinQuiz gold nugget: direct gives control but comes with complexity. Indirect gives access and ease but with less say. Finally, we've got indirect investment structures. These include open-end and closed-end funds. Open-end funds let you continuously invest and redeem, typically offering stability and focusing on income-generating properties. Closed-end funds, they're more aggressive, often targeting distressed or redevelopment opportunities, and they come with a fixed life. One last exam reminder: always connect the structure to the investor's objective. If they want steady income with liquidity, think REITs or open-end funds. If they want long-term growth with more risk, think direct equity or a closed-end value-add strategy. And hey, before we close this out, everything we just walked through, it's right there on your screen in the battle-ready summary. This visual guide is your shortcut to revision before the exam. Use it with your notes, pair it with FinQuiz's Stanley Notes, formula sheets, and the question bank, and you'll be a lot more confident walking into that exam hall. Okay, folks, now that we've explored how to get into real estate, let's zoom in on what makes this asset class tick. In this section, we're talking about the characteristics of real estate investments: what drives returns, what risks you're really signing up for, and how this thing plays with the rest of your portfolio. The good, the bad, and the rewarding. So, real estate has a lot going for it. It's not just about owning a piece of land or a building, it's about making your money work for you in ways that other investments can't quite match. So why does real estate get so much love from investors? Let's break it down. Well, first off, steady income. Picture this: a commercial office space in Chicago leased out to a mid-sized law firm on a 5-year fixed lease. Every month, rent rolls in like clockwork. That's predictable cash flow, great for pension funds, insurance firms, or even high net worth individuals looking for some consistency. And because these leases are often long-term, you're not dealing with the kind of price drama you'd get from equities or crypto, right? If you've ever rented an apartment, you've contributed to this. Commercial leases, in particular, are gold mines for investors. They're often locked in for years, which means predictable cash flow. It's like having a steady paycheck, but better because you're the landlord. Then there's the inflation hedge angle. Imagine you own a strip mall in Florida. Rents are tied to CPI, and inflation just ticked up to 4%. Boom. Your lease agreement adjusts upward. That means your rental income also keeps up with rising prices, which is something that bonds, especially fixed rate ones, struggle to do. Now let's talk about diversification. Ever heard the saying, don't put all your eggs in one basket? Real estate is the perfect antidote to an overly stock-heavy portfolio. Its low correlation with stocks and bonds means that when markets tank, Your real estate investments might just hold steady or even thrive. So, folks, real estate doesn't move in lockstep with the stock market. Back in the 2000s, when tech stocks were bouncing all over the place, REITs and private real estate held up differently. The CFA exam loves this point. Expect a question where they give you a portfolio with 60% equities, 30% bonds, and a 10% wild card, and they'll ask which asset class improves diversification the most. The answer? You guessed it, real estate. And now? Of course, the big one, long-term returns. Think about a real estate fund that bought industrial property on the outskirts of Atlanta back in 2012. It sat there, collected lease payments, and fast forward 10 years, Amazon distribution centers start popping up nearby. Voila, the property doubles in value. That's capital appreciation on top of a decade of income. Now, where do these returns actually come from? There are two sources. Rental income, which is your bread and butter lease payments, think low risk, stable cash flows. And then there's capital appreciation, the upside that comes when a property increases in value. That could be due to development, market demand, or even good old gentrification. But here's where things get fun or complicated, depending on how much coffee you've had. There's a whole risk-return spectrum for real estate strategies. Now, depending on your risk appetite, you can choose different strategies that fall along the real estate risk-return spectrum. At the low-risk end, we've got senior debt. That's stuff like first-lien mortgages or investment-grade CMBS, basically the real estate version of government bonds. You're not swinging for the fences here. You just want steady interest payments and a solid claim on the property. So senior debt is low-risk bond-like returns from things like first mortgages and investment-grade commercial mortgage-backed securities, CMBS. Think of this as the slow and steady approach. Move up the scale a bit and you hit core and core plus. These are stabilized buildings in good neighborhoods, like an apartment complex in Dallas with 90% occupancy. Core is more conservative. Core Plus maybe needs some light renovation or tenant repositioning. Now enter the Wild West, value add and opportunistic strategies. Think of a half-empty shopping mall in Phoenix. It's ugly, outdated, and the anchor tenant just left. When we talk about value add, we're in medium-high risk territory. Think about leasing vacant space or redeveloping a property to increase its value. It's more work, but the payoff can be significant. A value add strategy says, let's revamp this place, bring in new tenants, maybe rezone it into a mixed-use development. High risk, yup, but also high potential return. And opportunistic strategies, this is the high stakes table. You're dealing with development projects, mezzanine debt, or distressed situations. It's risky, but the potential for cash flow growth is off the charts. Opportunistic strategies are the moonshots. Full-on development from scratch, distressed debt, or taking on properties nobody else wants to touch. Like an abandoned hotel post-COVID that gets turned into a trendy co-living space in LA. Now keep this in mind for the exam. The CFA Institute loves giving you scenarios with 3 or 4 real estate funds, each with different characteristics, and then asking you to match them to core, core plus, value add, or opportunistic. The clues are always in the tenant stability, renovation level, and financing type. So folks, remember, the further you go up the risk spectrum, the higher the potential reward, but also the bigger the potential headache. Add leverage into the mix, and both your gains and losses can get magnified. It's like turning up the volume on your investment strategy, for better or worse. All right, so let's tie this to diversification benefits. For starters, it offers bond-like cash flow. Regular rental income provides stability even when other parts of your portfolio are bouncing around. Then there's the potential for capital appreciation, which add. Real estate adds a new flavor to your portfolio, something that's not totally tied to the ups and downs of the S&P 500. In fact, some strategies have bond-like income streams, while others behave more like equity with potential for big upside. But the real thing is its low correlation with stocks. When the stock market takes a nosedive, your real estate investments might just keep humming along. That consistency makes it a favorite for investors looking to reduce overall portfolio risk. Now, REITs take this to another level. These beauties combine the best of both worlds, steady income and the chance for appreciation. They're like convertible bonds, but with more upside. Plus, rates are easy to buy and sell, making them one of the most accessible ways to invest in real estate. So, folks, remember, they're unique because they blend income and appreciation like convertible bonds, but with a roof. Some investors treat real estate investment trusts like fixed income, others see them as equity, and some argue they're a class of their own. Now, investors now have access to REITs and private property markets around the world, from warehouse spaces in Germany to retail hubs in Singapore. Adding global real estate helps even more with risk-adjusted returns, smoothing out volatility. They're more correlated with the stock market than private real estate, which means they can be volatile, but they're also highly transparent and liquid, which is a big plus for investors who don't want to deal with the headaches of direct property ownership. There's still a debate about whether public and private real estate behave the same way. Listed real estate, like REITs, tends to move with market benchmarks, especially during downturns and recoveries. Private real estate, on the other hand, can have a delayed reaction due to slower appraisal cycles. During the 2007 to 8 crisis, equity REITs fell hard with the rest of the market, but private real estate valuations lagged. That's because listed prices react instantly, while private appraisals take time. That mismatch? CFA exam gold. Expect a question on public versus private real estate performance correlation, especially during downturns. So, bottom line, real estate isn't just bricks and mortar, it's income, appreciation, inflation protection, and a powerful diversifier if you know how to use it. All right, let's move on to infrastructure next. All right, folks, now that we've covered real estate, let's talk about its fascinating cousin, infrastructure. That literally shapes the world around us. If real estate is about buildings, infrastructure is about the systems that keep our lives running. And no, I don't just mean highways and power plants. In the world of investments, infrastructure is a whole asset class. It includes land, buildings, and long-term assets that keep economies running. Stuff like airports, data centers, toll roads, even water treatment plants. Think about your morning commute. Whether you're driving on a highway, taking the subway, or catching a flight for a business trip, you're using infrastructure. Investing in this space means putting your money into assets that provide essential public services. These are the big-ticket, long-term projects that keep society running smoothly. We're talking about roads, bridges, airports, utilities, and even the technology that powers your Wi-Fi. Without infrastructure, the modern world would grind to a halt. Infrastructure investments are unique because they aren't just about making money. They're about fueling economic, technological, and social development. Think of them as the foundation for everything from your morning commute to the electricity powering your laptop right now. Now, infrastructure isn't new. Historically, these mega projects, bridges, subway systems, hydroelectric dams, were financed by governments or huge conglomerates. But starting in the late 20th century, private money started flowing in again, especially as governments shifted to partnerships and offloaded certain projects to the private sector. Now, how infrastructure investments work. Here's the deal. Infrastructure investments aren't like your typical stocks or bonds. For one, they involve massive, capital-intensive assets with long timelines. We're talking decades, not years. Cash flows in this space also work differently. Instead of traditional leases or rentals, infrastructure projects often generate income through contractual payments. Things like availability payments, paid for keeping a facility operational, facility fees, tolls, or take-or-pay agreements where users commit to paying whether they use the service or not. Think of a toll road in California. Every car that passes through, someone's getting paid. Or a data center in Virginia. The contracts aren't month to month like an office lease. They're multi-year agreements tied to digital infrastructure demand. One of the most exciting trends in recent years is the rise of public-private partnerships, PPPs. Governments and private investors team up to fund, build, and operate infrastructure projects. Why? Because governments don't always have the resources to go it alone, and private investors bring expertise and capital to the table. A great example is the European Bank for Reconstruction and Development, EBRD, which supports infrastructure projects worldwide. This kind of collaboration creates opportunities for experienced investors to step in and make a difference while earning solid returns. So folks, remember, governments often team up with private investors to get projects done faster and more efficiently. For example, in the UK, the Thames Tideway Tunnel was built through a PPP structure, blending government oversight with private investment funding. These partnerships are becoming standard across Europe, Asia, and even Africa, especially where development banks like the EBRD step in to support financing. Now, infrastructure comes in two main flavors, economic and social. Economic infrastructure supports economic activity like day-to-day functioning of the economy. Picture highways buzzing with cars, railways connecting cities, airports handling millions of passengers, and power plants generating the energy we all rely on. Income here is often usage-based. Think tolls, fares, or fees for services. Think airports, power grids, telecommunication towers, railways. You get the idea. These tend to generate income based on how much they're used. So if more people fly through JFK Airport or stream videos from Netflix, that creates more demand for the underlying infrastructure, runways, data cables, you name it. Social infrastructure, on the other hand, is about public services, schools, hospitals, housing projects. The revenue here isn't usually tied to demand, but rather contractual lease payments from the government or a healthcare provider. For example, a private investor might build a hospital wing and lease it to the NHS in the UK under a 25-year lease. Pretty stable, right? So the point is that social infrastructure focuses on public services like education, healthcare, and housing. Imagine hospitals, schools, and correctional facilities. The income for these assets usually comes from lease agreements with governments or private providers. It's more about stability than market demand, making it an attractive option for risk-averse investors. Now, let's talk about where in the project lifecycle an investor can jump in. There's greenfield, brownfield, and secondary stages. Greenfield is the riskiest but also the most exciting. These are the from-scratch developments, completely new assets that need to be built from the ground up. Think of constructing a new toll road or a high-speed rail line. The risks are high. Hello, construction delays and cost overruns. But so are the potential rewards. A popular model here is the Build, Operate, Transfer, BOT structure, where a private company builds the asset, runs it for a while, and then hands it over to the government. Greenfield is about building a project from scratch. Let's say a solar farm in Arizona. It doesn't exist yet, but once it's built and operating, it'll generate steady returns for years. The catch? You're on the hook for construction delays, cost overruns, and permits. CFA exam might ask you which infrastructure stage carries the most development and execution risk. Yep, greenfield. Brownfield is less risky. It means acquiring or upgrading an existing facility. Brownfield investments are all about improving or expanding existing infrastructure. This might involve taking over a government-owned power plant, upgrading it, and running it more efficiently. The beauty of brownfield projects is that they come with immediate cash flow and a track record, so the risk is lower than with greenfield projects. Imagine buying out a government stake in a toll bridge or expanding an airport terminal. There's already an operating history, so you can underwrite cash flows more confidently. A CFA exam question here might ask, which stage allows for quicker cash flow realization with moderate risk? The answer, brownfield. Then there's secondary. This is the safest of the bunch. You're buying into a fully operational income-producing asset. Think of a power plant in Germany that's already been running profitably for years. You're buying stable, known cash flows, risk is low, returns are steady. This is where pension funds often like to park their money. Here you're investing in fully operational assets with established cash flow. Think mature toll roads or wind farms that are already generating income. The returns might not be sky high, but they're stable and predictable, making them ideal for conservative investors. Now, forms of infrastructure investment. You've got direct and indirect. Think of it as choosing whether to steer the ship yourself or buy a ticket for the ride. Both get you there, but the journey feels very different. Direct investing gives you more control and more risk. You're hands-on, managing the asset, calling the shots, and potentially reaping higher returns. However, this approach demands significant capital, specialized expertise, and the patience to deal with illiquidity. It's no surprise that large players like pension funds and sovereign wealth funds dominate this space. This is typically done by massive investors like the Canadian Pension Plan Investment Board or sovereign wealth funds in the Middle East. They go in, buy a stake in an airport, and manage the project alongside other institutional partners. But it takes big capital and involves illiquidity, political risk, and sometimes complex operations. Take the Ontario Teachers' Pension Plan, for example, which has a stake in London's Heathrow Airport. Their direct investment gives them a voice in operations and a slice of the airport's steady cash flow, a great payoff if you have the resources to make it work. Indirect investments are much more accessible to individual investors. Options include infrastructure funds and ETFs, which offer a diversified basket of assets like power grids or communication towers. It's like a buffet where you sample a bit of everything without committing to a single asset. Most retail and mid-size investors go the indirect route. That means investing in infrastructure ETFs, listed infrastructure companies, or master limited partnerships, MLPs, especially in energy sectors like pipelines. These provide exposure without needing $500 million to buy half a dam in Switzerland. Then there are publicly traded infrastructure companies, firms managing assets like pipelines or data centers. Think of a company like American Tower, which owns thousands of communication towers worldwide. Each Netflix stream or video call indirectly adds to their success, and as an investor, you benefit too. Folks, these MLPs focus on energy infrastructure. They are popular with income-focused investors because they offer tax benefits and regular payouts. Imagine collecting steady income from oil or gas flowing through pipelines without the need to own or manage the infrastructure directly. Now here's what you might see on exam day. They could describe an investor seeking income inflation protection, and low correlation with equities, but they don't want illiquidity. Your best choice? Indirect infrastructure via listed vehicles or MLPs. What makes indirect investments so appealing is their liquidity and flexibility. Unlike direct investments, where your money is tied up in physical assets, you can easily buy and sell shares of infrastructure funds or companies in public markets. It's like choosing a quick flight over a slow road trip. You still reach your destination, but with far less hassle. So, just to recap, infrastructure is all about long-term real asset investing. It's capital intensive, built for essential services, and structured around contractual income rather than market swings. Whether you're buying into a toll road, telecom tower, or hospital, it all comes down to matching the investment stage, income structure, and liquidity profile to your risk appetite. So, alternative investments, especially real estate and infrastructure, aren't just niches for the ultra wealthy. They're essential components of a well-rounded portfolio. They offer unique benefits like income generation, diversification, and inflation protection. But like any investment, they come with their own risks and challenges. And remember, the battle-ready summary on your screen right now, it's showing you everything you need to anchor this in memory. The greenfield, brownfield, secondary breakdown, public versus private role shifts, and economic versus social infrastructure that tie it all together. If you're preparing with FinQuiz, don't just rely on reading the notes. Tap into the mock exams, formulas, and the full summary sheets we've built to make your CFA prep battle-tested and retention-friendly. The link to purchase these products is in the description of this video. All right, folks, that's a wrap for today's lecture. You've just leveled up your understanding of real estate and infrastructure investments, two big pillars of the CFA curriculum under the alternative investments section. Keep reviewing, keep connecting the dots, and trust the process. You've got this. Good luck, and I'll catch you in the next session.